So today we want to finish up bonds, and we're going to have a fairly lengthy discussion on stocks to get you ready for papers 3 and 4. And there's another video out there that does the same thing. So stocks have a whole lot more involved because with bonds, it's all in the contract. You know exactly what your cash flow is. All you have to worry about is if they default. With stocks, not so easy. We got to do a lot more analysis. So we'll finish up bonds. Last class, we talked about spreads, and we talked about high quality bonds have smaller spreads than low quality bonds. And also, if you go out in time, spreads increase as you go out in time. It's called the term structured credit spreads. So the further out in time you go, the wider the spread's going to be. The lower the quality, the wider the spread's going to be. And so we'll be using a table like this on the exam. What I'm going to do, maybe on Wednesday or maybe next Monday, I'll see, maybe next Monday, we'll start practicing some of the exam questions for exam 2. I'll get them to you in advance, and then I'll look for volunteers to come up and work the problems so we can make sure everybody knows exactly how to do it. Some students just completely ignore that, don't worry about it until the exam, and then it just kills them. They're not ready at all because it's a lot of problems. You want to get in practice. Plus, this is all stuff that you should be able to do off the top of your head. You shouldn't have to memorize it or study it. You should just know it because you did most of this stuff in 3013 anyway. So it's somewhat rehashed. So you should just know it off the top of your head because this is stuff we do all the time. Accountants, finance majors, valuing a stock is a pretty normal thing to do. So we had this stock, this bond. It was a 20-year bond, but it was issued 5 years ago. So 5 years ago, the 20-year treasury is 2.5%, and AA spreads were 60 basis points. 5 years ago, this was a 20-year bond rated AA. But today, what is it? Today, it's a 15-year bond rated single A. So when it was issued, its coupon would have been 3.1%. Why? Because the risk-free rate 5 years ago was 2.5%, and the spread was 60. So 2.5 plus 60, that's 3.1%. Bonds always issue right at par, which means their coupon or yield is going to be the same. So if yields were 3.1% 5 years ago, the bond would have been issued at 3.1%. So we know what the coupon is. The yield today is, it's a 15-year bond and it's single A rated. So today it's going to be 2.45%. So we know that going in. We're always going to assume that the face is $1,000. Just helps with rounding. And then we need the effective yield. The effective yield just takes into consideration that the bond pays twice a year. So we got to somehow put that compounding effect in there. Effective yield is a really good thing to know. You just take 1 plus the yield of maturity divided by 2, raise that to 2 minus 1. I'd practice that a few times. You'll know if you have it right or not, because if you get something below 2.45, you did it wrong. But you're not going to get anything radically above 2.45. So if you're getting 362 or something like that, you're way off. So it's probably going to be 246, maybe 247, but probably 246. So you take 1 plus 245 divided by 2 squared minus 1. That's going to be the actual discount rate we're going to use. And it's just taking into consideration. Now, there are other yields out there. There's bond equivalent yield, there's yield of worst, there's other yields out there, but the effective yield is the one. You probably have seen it. We talked last class. You've probably seen it. Also talked about is the APY. If you're looking at certificates of deposit, they call it APY, the annual percentage yield. It's just an adjustment to take into consideration that it doesn't pay just once a year. It pays multiple times throughout the year. All right. So effective yield's a fairly simple calculation that we use quite a bit. You see it quite a bit, not just on investments, but even on auto loans and other things where you're paying more than once a year. So you have essentially interest on interest kind of thing. All right, so we need to calculate the value of this bond. You notice what we're doing is we're not calculating what we think this bond is worth. We're actually calculating the current market value of the bond because we're using market yields and market spreads. So we're actually trying to figure out what the market thinks. If we're trying to figure out what the bond is worth, we're probably going to focus our efforts right here. Do we think 65 basis points is enough to cover us for the risk of this bond? So that's, and I can assure you that's the way bond people talk. My office was right next to the trade desk, and the bond people would come over and they talked entirely in spread. That's all they said. I can still remember the day Matt came over and said, I wanted it at 20 over, and the guy said, I wanted it at 20. The guy said, no, I got it at 15. He says, no, I wanted 20. I got 15. They were debating. Matt wanted to buy the bond at a yield that had 20 basis point spread. The guy who was doing the trade couldn't get it at that good of a spread, and Matt's upset. That's the way they talk. He didn't talk about the risk-free rate. He ignored that entirely. He entirely focused his effort on that spread. That's just the way bond people are. So what we'd really be focusing in is 65, a good spread. We might find another single A bond that's paying 75. But we might look at it and say, well, they're both rated single A, but one really is riskier than the other. They're not all exactly the same. So a typical single A bond can have a few basis points range because people will disagree on the quality of the bond. But that's really what you're after. Well, we're not doing that. We're not figuring out what we think this bond is worth. We're trying to figure out what the current price of this bond is. All right. So let's start off with our guess. So our guess, we're going to say the percentage change in the price should equal minus duration times the change in yield. What duration would you guess on this bond? It's a 15-year bond, so it's less than what? It has to be less than 15, right? The duration is going to be less than. It's not going to be 5. Remember the 10-year bond? What are you getting on the 10-year bond? Was it $7.99? So $7.99. So it was a good 2 years shorter. 15 is going to be even more. Any guesses out there? I haven't done a 15-year bond at this low interest rate in a while. Is 12 maybe all right? If the 10-year, or maybe 12.5. The 10-year, we took 2 off. Maybe we'll take 2.5 off. So let's try 12.5. We'll get the actual number and see. So we'll take minus 12.5 times, how did the yield change? Well, today the yield is 245. When this bond was issued, the yield was 3.1. So interest rates have fallen. So when we do that, we should get minus 12.5 times 0.0245 minus 0.031. We should expect this bond to be about an 8% premium, or $1,000 times 1 plus that. I'm going to guess somewhere around 1,081, which to me, it's going to be somewhere in that 1,050 to 1,100, I would guess, because there's not a big difference between 3.1 and 245. They're not radically off. So I'm not expecting this to be a $1,300 bond, but we'll see. 15 years is a long time. Then we use the formula that I never get right because I can't get the parentheses in the right place. So let's just try it. So we know we're getting $1,000 times 0.0245 divided by 5. So we're getting, $1,000 times 0.031. We're getting that twice a year. So we're getting, that's our coupon, right? Our coupon in dollars is the face times the coupon percent divided by 2, because we get it twice a year. So $1,000 times 3.1 divided by 2. So we're expecting $15.50. What's the infinite value of that? If we got that for all of infinity, it'd be 0.0245 divided by 2. So that would be worth $1,200. So someone said, I'm going to give you $15.50 every 6 months for all of eternity. That would be $15.50 divided by the interest rate. Here, because it's twice a year, we take the yield of maturity and divide by 2. All right, but we're not getting that. Because we're also getting $1,000, right? But we're not getting the 1550 divided by 0.025 divided by 2 for all of eternity. We're just getting it for 10 years. So we need to take that $1,000 we're getting 10 years or 15 years, excuse me, in 15 years, but subtract the 1550 after 15 years. So we raise all of this to the, or we divide all of this, 1 plus 0.0255 divided by 2. We raise it to what power? How many periods are there? It's 15 years, but we don't do 15, do we? What do? We do 30, right? So it's 30 periods. Y'all think I got it right this time? Yeah. And last time I messed up here on this parentheses. Let's see. Does that look like that could be it? Looks pretty reasonable, doesn't it? Now you don't have to do this on the exam. I'm just telling you what your calculator is doing.
What do we need to do on the exam?
This next one. This next part's the required part. So on the exam, you're going to put time, cash flow, discount factor, discounted cash flow. All right. So you have to do this on the exam. It'll probably only be a 2-year bond. So it won't be quite as much work as this. If I could do the exam on Excel, I would give you a 20-year bond, 15-year bond, because it's pretty simple. So we get our first cash flow in 6 months. And then we get a cash flow every 6 months after that. So until we get out the 15 years, there's our cash flows, right? So there's your time. What's our cash flow going to be? It's going to be $15.50 until when? Until year 15, then what do we get? Get our $1,000 back, all right? What's our discount factor? Plus 1 divided by 1 plus the effective yield or the yield of maturity? Which one do we use? You got a 50-50 chance to just guess if you don't know. Yeah, effective yield. All right, that's the reason we're doing the effective yield. All right. So 1 plus the effective yield raised to the time. You should get something 0.99 something, whatever. We usually go out 4 decimal places. On the exam, you got 4 decimal places. You're gonna have an issue with rounding, but that's fine because when I grade the exam, I actually take the rounding in consideration in Excel. So we got to discount each one. The discount rate factor is going to keep declining as we pass through time. So a discounted cash flow, we just multiply across. So $15.50 that we're going to receive in 6 months is worth $15.31 today. $15.50 we get a year from now, discounting at $2.45 is worth $15.13. We copy that down and we get the actual price of the bond using the table. Does that look right? Looks pretty good, doesn't it? Now, on the exam, you can use a financial calculator. I don't care if you can double check your work, right? You should be able to plug this into a financial calculator. That's fine. You don't get any points for knowing how to use a calculator. Because once you graduate from UTSA, you may never touch a calculator again for the entire rest of your life. So that's fine. You can double check on the calculator if you want to, but I need to see this table. If you don't give me this table, you will not get credit, even if you're right to the penny. Because I know your calculator knows how to do it. I don't care about that. I want to know if you know how to do it. All right. I want you to visually see what a bond is. A bond is the present value of all those cash flows. I want you to visually see what the calculator is doing for you. We can calculate duration. You don't have to do that. You don't need to do that on exam, but duration is just a weighted average time to maturity. So the first weight is 6 months. times the discounted cash flow divided by the total cash flow. So the actual duration is probably going to be less than 12 years because we should have some significant convexity here. So 12.24, but my 12.5 was not a bad guess there. And you would expect this to be less, right? Y'all remember what we talked about? So if we use the actual convexity, my guess is 1,079. Why is it less than 1,081? Anyone remember? It's that word we used last class. It's just a few days ago. Duration underestimates the price change. Why? Because this bond has what? Someone in here has got to know the answer to that. Convexity, thinking, what kind of convexity? Positive convexity. Because of positive convexity, duration is going to understate the actual bond price by a little bit. Because this bond has positive, it doesn't have much positive convexity, but it does have some positive convexity. All right. So there's our duration. Pretty cool to have duration so easy to calculate. Y'all see how duration really is just that weighted average time to maturity. It's a really simple calculation. When did it discover duration? Sometime in the 60s. There's a podcast with I might have told y'all this before, but again, this is a good time to mention it. Dr. Ibbotson from Chicago School. He started his career in the 60s and 70s. He was a bond investor, and he had been reading these papers about duration. So he was using it in the job. And he said it was so easy back then because most of the people he's competing against didn't know anything about duration. He said it gave him a huge advantage. There are people completely ignoring interest rate risk, interest rate theory even. It was a much easier time. When I grew up in my career, the people I started with were trained old school in the 70s. They didn't know what duration was. They didn't know what convexity was. It was kind of embarrassing at one point. Money Magazine published an article on duration. And so all of our customers started calling us, asking what the duration of our mutual funds were, and the portfolio managers didn't know because they were all old school. The people there now, they know this stuff backwards and forwards because it was a big part of the 90s and what they got on the CFA exam. But the people I started my career with, you know, they were good 40 years older than I was. They've been trained in the 50s and the 60s, or maybe not that far back, maybe the 60s and 70s. They never had this stuff, and they're just, you know, so you always have to be careful. What's the new stuff coming in? Always be reading. I always made it a point to read the important journals out there. There's several of them out there. The Journal of Portfolio Management. The Journal of Fixed Income. And these are the kind of things you want to subscribe to. The Financial Analyst Journal. Oh man, word 5. Yeah, sorry, Bill Gates is not helping me out here.
Do you think you could upload this Excel file?
Yeah, I'll put it out there. The Financial Analyst Journal, it's the simpler of the two. I mean, those other two are pretty complex journals. They're really hard to read. They get pretty advanced really fast. Financial Analyst Journal is what the CFA produces. It's much more readable. But these are the kind of things you should be reading. The Journal of Portfolio Management, I don't know who publishes that. I don't know if it even tells us who publishes it. But you want, even if it's a little advanced, you still want to read it just to see what are the topics going on. A lot of the stuff is some professor somewhere who's written a paper that no one understands and will never go anywhere. Doesn't mean anything. It's not important. That might be 8 out of 10 of the articles, but 2 of the articles may be really critically important. So what is the industry talking about? What are people doing? Is there any new way? It's all about return and risk. Is there some new way to look at risk for a bond? So when Dr. Ibbotson started, it was all about duration and convexity. He understood it. He was dealing with people who'd never heard of it before. It gave him a huge, huge advantage. So, and I remember my risk management class, I read the article on style analysis, and boy, it was like, wow, this radically changes the way I think about risk and analysis. Started doing it immediately where I worked. The people I was working for had never heard of it, had no clue what it was. So you always want to be, I mean, you don't want to become a dinosaur. Your first job might be with a dinosaur. And what happens if you do that? You quit and go work somewhere else. I can tell you so many stories of students that they became indispensable in the first 3 months of their first job. There's no college student that should be indispensable within 3 months. Don't you all agree with that? If your firm finds you indispensable after 3 months, your firm is in trouble. All right, you're smart people, but you're not that smart. You shouldn't be teaching your boss after 3 months. After 3 months, you should still be deadly intimidated by your boss because they know so much stuff. So if you find a boss that you're teaching, and I've known bosses, they don't know anything about Python or Excel or Bloomberg or Capital IQ, all that stuff is like, oh, that's stuff. I had one student here in town, a company here in town, he wanted to automate his entire department using Python. It was going to save them a lot of money. And the boss said, no, because if you leave, who's going to know how to do it? It's like, that's a horrible boss. You don't want that. So you need to be learning this so you don't become that dinosaur of a boss that doesn't know anything and new people are coming in and you're kind of dead weight. So read constantly. So once you graduate, the reading increases. You're just constantly doing it. And these are the kind of things to read. They're really, my guess is if I click on one of these, this is an interesting one, inflation risk premium. They're probably going to ask me to log in pretty quickly. A simple consumption-based model implies that the inflation risk premium should be high when inflation and growth are more negatively correlated and vice versa. The authors calculate 2 measures of inflation risk premium. That's actually looks like a pretty good article there. This one doesn't look too complicated. It looks really interesting. The inflation risk premium, how much should that be? Right now, that's probably a pretty big topic. Doesn't look like what they're writing is all that complicated. You probably could figure it out. Wow, I want to actually just go read this article right now. All right, so make sure you're staying on top of all this stuff so that it gives you an edge in your job. All right. Let's try one that's going to be more like on the exam, and then maybe next Monday we'll do the return and the bond calculation problems so y'all can get some practice. But let's say we have a 10-year corporate bond issued 8 years ago. It was AA at issue, but is BBB minus today. Maybe it's some consumer retail stock that got crushed by COVID or something that had been downgraded. The guy I used to work with at UTSA, he always called these cuspy bonds, BBB minus cusp, right on the cusp of investment grade and below investment grade, just right on the edge. One more downgrade and their bond price is really going to get crushed. All right, the face, we'll just keep that at $1,000. So 8 years ago, let's say the 10-year, let's say was 4%, and the 2-year was 3.5. Today, the 10-year is 2.5, and the 2-year is 2.3. And spreads, AA spreads, we'll keep that the same. The 10-year 2-year, remember what we said on the 2-year, it's gonna be much narrower, right? And then the triple B minus, the spread, let's see, 175, 190. So what would you say is the most likely coupon on this bond? Guesses? Where were interest rates 8 years ago? Risk-free rate was what? 4%, right? Huh?
Plus the spread of 60.
And so the spread, so what was the likely coupon then? Well, you can, yeah, you don't want to do it. Yeah, that's great. You can do that off the top of your head. That's good. So the coupon in dollars is $23, right? Every 6 months. Y'all agree with that? Stefan did it off of his head. Can y'all do that off the top of your head? He had to do like 3 calculations in there. He had to add 4 plus 60, but how did he get the 60? He divided by 10,000, so 4 plus 0.6, that's 4.6%. That's $46 divided by 2 is $23. So that's good. He can do all of his head. But the actual rate is going to be 0.04 plus 0.006. So that's the coupon. What's the yield of maturity then? What's our risk-free rate today? Someone just yell it out. 2 point. Well, the risk-free rate. What's the risk-free rate today? The risk-free rate today is at 250 or 230? 230 because it's a 2-year bond now. And what's the spread? 175, 190, 20, 60. What's the spread? 90. Can you do that in your head, Stefan? What's the yield of maturity? For 20 sounds good. Does that sound right? 2.3% plus 190 divided by 10,000. Or 420. Did you say 420 or 430? So 420. And then the effective yield. I don't like this one because the yield and the coupon are almost the same, but that's okay. The effective yield, we just take 1 plus 420 divided by 2, raised to the second minus 1. So 424. It's a 2-year bond. So what would be your guess duration? This one's pretty simple on the exam. So I would go with 1.9. That just sounds to me about right. So your guess percentage change, just minus duration times the change in yields. Yields today are 420. They were 460 when this was issued. So we expect this bond not to be up much whatsoever. So $1,000 times 1 plus that, just $1,000, 760. That looks about right. I made a mistake of making the coupon yield maturity about the same. So this bond price hasn't changed all that much over time, even though interest rates have fallen dramatically. So why didn't this bond go up in price when interest rates fell so much? Because what else happened to this bond? The spread gapped out quite dramatically, right? So you picked up a lot of price because interest rates fell, but you lost a lot of price because the bond was downgraded. The fall in interest rates, 150 basis points, was less than the rise in spreads, 130 basis points. So the bond's going to go up a little bit in price, but not much. You would have much better off probably if you bought the 10-year treasury, but it's hard to say that, right? If you bought the 10-year treasury, you would have made 4%. You buy this bond, you get 4.6, but it got downgraded. It's hard to say you would have been better off buying the 2-year treasury. You would have been much better off probably buying a AA bond that didn't get downgraded. That probably would have been a much better deal, right? Because then your discount rate would have been what? 2.7. And that probably would have done me a lot better than a 10-year. But it's not obvious what's the best solution, because the 10-year treasury, yeah, it gives you a lot of price appreciation, but it only gave you 4% yield when you could have gotten 4.60. So you have a lot of things going on here. But for this bond, it probably would have been better if we bought the 10-year treasury. We would have gotten 4%, but we would have gotten a pretty good price pickup. But still, if they both mature at par, the 10-year treasury would have gotten you 4%, and this would have gotten you 4.6. From a return standpoint, the 10-year treasuries the 10-year corporate would have given you 4.6. You would have been better off. That extra 60 basis points may not have been good to cover you for your risk, because this bond got really risky, but you still would have made more money. So from that standpoint, and if you knew for sure going in it was going to mature at par, you would have preferred the 4.60 over the 4. All right, so our guess is that. Let's do the actual formula. See if I can do this. So plus 23 divided by 0.042 divided by 2 plus $1,000 minus 23 divided by 0.042 divided by 2. So that part of the equation is pretty straightforward, right? You do the 23 over 42 divided by 2. You do that twice, plus and minus. And you throw the 1,000 in there. All you got to do is discount this. Let's see. Divided by 1 plus 0.042 divided by 2. I don't like how I did that. Let me change it. And we'll raise that to the what power? So 2-year bond. Raise it to the 4th, right? Does that look close? Well, it's close to my guess. So it might be right. So I love this formula because it really does tell you exactly what a bond is. I thought of this formula while I was riding my bike one day. I thought, why don't we use this formula all the time? Because it's really is pretty straightforward. What I really love about this bond is if you take the $1,000 out of this formula, you'll see the present value interest factor annuity formula, which is exactly what that is. The present value interest factor annuity formula, it assumes you get a cash flow for 10 years that's equal. It's doing exactly what we just did there. Except for that formula, you don't get $1,000 in a few years. You just get the same formula. So if you take that 1,000 out and redo this formula, you'll see that present value interest factor formula just jump out at you. All right, so let's try it with the table. So we got time, we got the cash flow, discount factor, discounted cash flow. So 0.5, this one's really easy. Just 4 cash flows, starting off at 23. We get our $1,000 back. Factors real straightforward. 1 divided by 1 plus our effective yield. Raise the time. Present value. You get the same number 3 times. How would that make you feel on the exam? These are 3 pretty radically different ways to calculate it, and you got the exact same answer all 3 times. So you can see when it's a 2-year bond, this bond probably has very, very little convexity. So you actually wouldn't expect much of a difference. We can calculate the duration, just out of curiosity. the actual duration of 1.93. So you can see here, actually you got a higher price with the duration than you get, which is unusual. But with the 2-year bond, there's not much convexity at all. It doesn't have that much impact, and this is an estimate. And you also have to remember that you divide by 1 plus the yield. So that would probably bring it down. So the duration number, you use Macaulay duration, I mean modified duration. So anyway, yeah, 1,007.60 cents. It's just barely above $1,000. Would have been much higher than $1,000 if it hadn't been downgraded. All right, questions on that? This is your second class, the value bonds. You should be getting really good at it, but I haven't looked it up. If you only know how to do it on the calculator, I'm going to argue you don't know how to value a bond. That's my argument. You may disagree with that argument, but that's my argument. I know on the fact exam, you have to be able to use a calculator. I wish they wouldn't have calculators on fact exam. I noticed on the fact exam that the bond had paid coupons once a year, which makes no sense at all, but they're just trying to keep it simple for you. In real life, they pay twice a year. You can do that in your calculator. It's not that difficult to do. You just got to make sure your calculator knows that. But this is really what it's all about. Is a bond is a discounted cash flow, and so that's how you mentally should be able to understand it, right?
What is duration telling us?
Well, it's trying to tell us that, okay, this bond has a 2-year maturity, but we're getting some cash flows earlier. And because we're getting some cash flows earlier, that's going to reduce that price risk of the bond. Remember reinvestment risk? Reinvestment risk is helped because you're getting some cash flows here you can reinvest. So this bond, yeah, let's load it up on year 2 because you're getting $1,000 back at year 2, but at least you're getting, you know, $69 before then. So that kind of helps you. With a 15-year bond, makes a much bigger difference because you're getting a lot of cash back. You're getting $500 back in coupons even before you get the 1,000 at the end. And so, what I just hit. Okay, good job, Bill Gates. That's really what I wanted to do. What did I hit that gave me that? I don't know. Oh, I must have hit that. So what it's telling you is this bond, that's a 15-year bond, it really only has the interest exposure as a 12-year bond because you're getting a lot of your cash early. So that reduces that price risk, gives you some more cash to reinvest. Yeah. And you can, this might be a good time to go out there and actually look up modified duration and just see. I don't know how to take this out now.
Can you show us the formulas for discount factor?
All right, yeah. So if you want here, Macaulay duration, modified duration, y'all recognize this formula now? Boy, I wish I could take that annotation off. I don't know how to. So y'all see this formula now, right? It's taking T. What is T in my formula? The 0.5, the 1, 1.5, the 2. Y'all remember that, right? Times what? The present value of that $23. So it's doing the sum of those. Didn't I do that? 0.5 times its present value. Then 1 times its present value. And then I divided by what? The price of the bond. I did each one of those. Isn't that exactly what I just did? All right. So this is actually the price of the bond if you take the T out. So it's just, that's, the V means the value of the bond. So that's all Macaulay duration is. Modified duration is they then take Macaulay duration and divide it by 1 plus the yield. So it's exactly the same formula. You just have to make that one last adjustment for 1 plus the yield. And there's other things in here that you can certainly get into. I'm sure convexity is probably in here somewhere, like right there. So yeah, there's convexity and duration are closely tied. So here's a whole discussion on convexity. Notice they don't give you a formula on convexity. Convexity's formula, they are out there, but there's multiple formulas, and they'll give you different answers. So okay, Stefan, I don't know which formula you're talking about. The effective yield.
No, it's fine.
All right. Don't know how to take that off. Anybody know how to take this thing off?
You need to take the annotation and back up the problem.
I don't know why it would do that without warning me. Clear all. Okay, thank you. All right. It's a bond. What I do on the exam is I'll probably give you a table like this, or I might do something like I did just there in Excel. So the key is to know that the bond is whatever its remaining life is. It's 2 years left. It's a 2-year bond, and it depends on what its current rating is. So that's where you want to focus in your attention. I'd show the investment society this. I could probably show you all this too. I think it's pretty in my risk management class as well. So if you look at spreads over time, this is the median spread, 25 for AAA, 65 for AAA, 100 for A, 160 for BBB. Today, we're below that. This is as of February 28th. So that was after the Russian invasion. So spreads did gap out a little bit. If you look, spreads have gapped out. You're at 14. You look at the spreads just back last year. They were down to almost zero, almost nothing there. So spreads have gapped out, but they're still below their historical averages. Not by, well, actually single A is above. And what I was telling them, high yield is still well below where its historical average is. So high yield. Now, maybe because so many firms have been downgraded, there's more high quality, high yield. There's more double Bs, who knows what's going on. The max, obviously all of that is 2008. The max is just massive. The mins are here recently, actually. So, you know, these are good numbers to know what a typical AAA pays over treasuries, what a typical BBB pays over treasuries. These are good numbers to know off the top of your head, just so you understand these bonds. All right. So let's talk about valuation of stocks, unless there's questions on bonds. You probably won't buy a bond anytime in your life unless you actually go in as a bond investor. Bonds are not a retail market. Some of your family might be buying municipals. I'd recommend that they don't, because you're probably getting ripped off if you're buying your own municipals. You're not going to buy your own corporate bonds unless you're really getting ripped off. Those trade in $50 million, $100 million blocks. If you're trading 1,000, well, I don't think you could do 1,000, but if you're trading 100,000 blocks, and I know people buy municipals trading 100,000, but boy, it's just too small. You're getting really ripped off. It really is a market. You probably want to do mutual funds. It just makes a lot more sense. You get a lot of bonds, a lot of diversification. You can invest in a fund that's $50, $100 billion, and so you get a lot of diversification. But if you're a bond trader, then yeah, you'll be buying bonds is a pretty cool career. Y'all can already see there's a lot of mathematics behind bonds, a lot of stuff you can work with, a lot of analysis you can do. It's a pretty cool career. But let's shift over to stocks. So I'm stealing this from Dr. Damodaran in his introduction to valuing stocks. And he said a stock is a present value of future cash flows. So he says it's a value of an asset. We're going to talk about a stock. So you have an expected cash flow in year 1, an expected cash flow in year 2, expected cash flow in year 3, you have a discount rate. We generally use the same discount rate throughout, but there are people out there to use a different discount rate for every year, but we're not going to do that. So these cash flows are going to grow at some rate. This could be a company that's growing like at 40% right now. So you have them grow for 40% for a few years. But then you have what we call, and we're going to be using this on paper 4, you have what we call the steady state or the terminal growth rate. What we're going to assume is that every company at some point becomes a normal company. So if you have a company growing 30, 40, 50%, that's fine, but they're not going to do that for all of eternity. At some time, they're going to start growing like the economy. Because you can't grow at 50% if the economy is growing at 5%. It's just not mathematically possible. You can do that for 2 or 3 years, but you can't do that for 50 years or you become the economy. So every firm, Apple, Google, whoever, Microsoft, there's a limit. They just can't keep growing double digits. It's just mathematically impossible. And what is Apple now? $2.6 trillion stock. I mean, a $2.6 trillion company can't grow 20, 30%. There's just nothing they can do to produce that kind of growth. So that's what we're going to assume is a different growth rate for a few years, can be a really high growth, can even be a negative growth rate. And then we're going to eventually grow at some constant rate that's probably going to be tied to what we think the economy is going to grow. All right, so eventually, so how can Walmart grow faster than the economy? They can add more stores, right? Once they have a store every single corner, which in my neighborhood, they're essentially there. There's a Walmart just everywhere. I'm like equal distance between 4 of them. It's like, I don't know which Walmart I'm going to go to because they're all the same distance. They're all within 2 or 3 minutes. It's like crazy. But at some point you have every store there, they can grow with what? Population growth and inflation. Because, you know, they can't keep stealing market share because either they're going to be the entire market or, you know, eventually you can't go any further. Same thing with Amazon, same thing with anybody else. So your question is, how fast do they grow until they get there? And then how long does it take for them to get there? And that's a tough question. You're going to see on paper 4, that's the time period is the hardest thing for most students, because I'm going to give you some tricks on trying to figure out these shorter term growth rates. I'm going to give you a few approaches you can use. But then if you say, hey, they're growing 20% right now, but eventually they're going to grow 5%. I get a lot of students, how do I figure out how long that period of time is? And I'm like, I have no clue. It's a forecast. There are no rules on forecasting. Is it 10 years or 20 years? Yeah, it could be. It could be 40 years. One thing I will do that Damodaran talks about, if you're using a double-digit growth rate, 10, 20%, 10 years is a very long time for that kind of growth. So it's unlikely very many companies will grow faster than 10% for more than 10 years, unless they're just really, really small. But once they get to be a decent size, it just gets to be really, really tough. Now you might say, well, what about Amazon and Apple and Microsoft? Yeah, a lot of them went for a little longer than 10 years, not much, you'd be surprised. But I'm also talking about 5 or 6 companies out of tens of thousands of companies. They're the exception, they're not the norm. Right? There aren't 1,000 Microsofts running around out there. All right, so that really, those really strong growth companies just are not doing. I mean, how's Zoom doing now? They're still growing fairly fast, but not nearly as fast as they were, right? So it's just hard to keep up. How's Facebook doing? They're actually showing a reduction in users. Netflix, how are they doing? I mean, what happens when Netflix has 5 billion customers? Where's their growth after that? It's all price appreciation. They have to increase their prices right after that.
Will there ever be a point where a company grows so much that its growth inverts to the negative?
Well, yeah, I mean, the point is, I'll start shrinking because of new technology. I mean, can you think of a company, if you look at the Dow, I think Exxon just got kicked out of the Dow. So Exxon was like the only one in there for a long period. I think GE was in there and they've gotten kicked out. I mean, GE was a company around forever and ever and ever, right? And now they're struggling. What's the longest running company you can think of? That's really, Microsoft's not that old, are they? That's a 1980s company. Apple's not that old. Apple started during my college years. Facebook started during your college years, maybe. No, not quite that young, huh? Well, Standard Oil is broken up now, so that's Exxon now. So, I mean, Exxon, yeah, they're oil companies, but where the oil company is going to be when we're all driving electric vehicles, who knows? So it's hard to think of any industry that just continuously is out there. Walmart is a 1970s company, and they're taking over. I think I told y'all when I was in college, Sears became larger than Kmart, and I thought it was incredible that Sears was larger than Kmart. It's like, I can't believe someone took over Kmart. Kmart was the big giant. Now they're both shrimps. They hardly even exist. So it's tough, right? Blockbuster was a fast growing company. Circuit City, y'all didn't even heard of Circuit City, have you? Have y'all heard of Circuit City? They were on the front page. They were the darlings of Wall Street. They were this great company. They went out of business. So it's just tough. Part of it's that technology changes and something new comes along, and the old guy can't keep it going. So yeah, at some point, a firm just at most they can grow with population growth and inflation. There's not much more they can do. They become a commodity, and all they can do is just kind of keep the engine going. So that's what you got to figure out. So most of y'all are probably going to pick a company that's new and exciting and interesting. So probably growing faster than normal. But how long are you going to keep that going? And it's hard to make that kind of forecast. It's always hard to forecast. The problem we're going to see with stocks is small errors in your forecast have huge impacts on the value of the stock. So if I think Walmart's going to grow at 4%, but they actually grow at 3.5%, my stock price is going to be off 25-30%. Just, if someone told me I thought Walmart was going to grow 4% the next 100 years, and you find out they only grew 3.5%, I would say, well, 4% wasn't a bad forecast. That's pretty close, right? It's not like they thought 8% it was 3.5%. They thought 4% it was 3.5%. That 4 versus 3.5 is a huge error in your valuation today. So it's very, very difficult. Stocks are very, very difficult to value. But that's what you're after, is you have to get this forecast of these cash flows. For the bonds, this was pretty easy, wasn't it? As long as the bond doesn't default, we know exactly what our cash flow is every 6 months, piece of cake. But for stocks, not so easy. Now, what about mortgage-backed securities? How easy are they to forecast? Is that cash flow the exact same every single month? What do your borrowers do to you every once in a while? They refinance. So you can see mortgage backs are a very difficult bond to value. To value a mortgage-backed security, you typically run 169 simulations, and you assume every simulation has equal probability, and the present value of those 169 scenarios, the average of all that's the value of a bond. That's how you price a mortgage-backed security. That sounded a lot more difficult than what we just did on the corporate bond, didn't it? A lot more difficult. So there are securities that get more and more complex. So stocks are some of those securities. Now on paper 4, I'm wanting you to pick a stock that's paying a dividend, which means these first few cash flows might be 0. Alphabet does not pay dividends. So their first few cash flows are 0. So the value Google or Alphabet, you got to decide when are they going to start paying dividends and start valuing that. Now, if you want to do a stock that does not pay dividends, there is a way we can get around that, but you got to check with me in advance, and we'll use your free cash flow as an alternative. But I want you to pick a stock that's actually paying dividends. In my examples, I generally use Walmart and Campbell's Soup. So those two you can't do because I've got those out there, even though it might change. So can you find a stock paying dividends? Yeah, there's plenty of stocks out there paying dividends. So certainly possible. Some of the more exciting stocks are not. Apple is paying dividends. However, Apple's dividends don't reflect the free cash flow of the firm, so you'll probably get a pretty low valuation if you use Apple's dividends. Walmart's paying dividends, and Walmart's not that difficult of a stock to value. Costco pays dividends, but Costco's dividends, they're all over the place. Costco is a difficult firm to value because sometimes they pay these massive dividends and then they pay small dividends. So when you're looking at their dividend, what do you use? Do you use the huge one they paid last year or the small dividend they paid 2 years ago? So there's some challenges in here. So you're trying to figure out the value of this high growth period and you're going to add that to the value of the steady state company when they become just a normal company. Now, when will Google become a normal company? Is that in 10 years, 20 years, 30 years? Who knows? Google is doing some interesting things. They're interested in healthcare. They're interested in autonomous vehicles. They're doing some cloud stuff. They're probably, I don't know, they're producing, well, I guess YouTube. Are they competing with Netflix? I watch YouTube more than I watch Netflix. Are they doing like full production shows now on YouTube, or is YouTube still, how much of what YouTube does YouTube produce? Is it still 0%?
They do release some stuff.
So they're actually producing stuff they're putting out there?
Well, I think they had rights to Cobra Kai, which is one of the big ones that they released years ago.
Or are they paying for the production? Or are they paying for the license? Are they actually hiring the actors and the,
Not sure.
you know, could YouTube compete with Netflix or Disney? You know, so they have their hands in everything, and their hands in everything that's growing. But at some point they're going to run out. And even if they don't, let's take Apple. What if Apple has the next really big thing? Well, the next really big thing starts off with a revenue of $10 million, and their current revenues are $100 billion. That $2 million thing is going to have to grow really, really fast before it has any impact on Apple at all. So, you know, it's just tough. Big companies cannot grow that fast. The other way to think about it is the cash flow from existing assets and then the cash flow in the future things that they do. So if you're doing a pharmaceutical company, they have existing patents and drugs that they're selling today. You can value those. You know when they're going to come off of their patent, become generics, you can value those, but you also know they're going to develop new drugs, right? I was talking to Investment Society about Monsanto. Interesting company. The mRNA has a lot of new applications for it. So they're going to be developing new drugs, no question. How do you put that in your forecast? You go back and look at the new drugs they developed in the past, and you try to figure out how many they're going to develop going forward. Really tough, right? Very, very difficult to do. Disney, every once in a while, Disney has a huge blockbuster. Toy Story was a pretty good blockbuster, wasn't it? That created what? How many? Did they up to number 4? How many did they do of those? So Star Wars. The last few Star Wars didn't do too well, did they? But who knows what? In the Marvel movies, when are y'all going to start getting sick of Marvel movies? I think I've seen one of them so far, but aren't they getting kind of boring now? I mean, how much more can you blow up the entire world without blowing up the entire world? You know, it's kind of getting ridiculous. But the first one is huge. What if Disney comes up with the next big blockbuster film that they can do 10 versions of and make all this money? So it's tough. So on some firms, valuing the existing assets, that's not even half of the equation. You got to think of what new thing you're going to do. So with Walmart, pretty simple, right? What new blockbuster thing is Walmart going to do? Home delivery, curbside pickup, that's not radical stuff, is it? That's not like a new blockbuster drug or not new blockbuster. So some firms are easier, some firms are more difficult. Campbell's Soup, we talked about that. There's not a whole lot of new stuff they can do there. So the firm you're picking is going to have existing assets. They're going to be doing new stuff, either have existing assets that are going to spread into new markets. Are they going to be developing new products so they have some growth there, and then they got a steady state when all that comes together and they can't do anything new. All right, and then your discount rate is going to reflect the risk of all of that. So that's how we're going to value a stock. He gives a few rules. Somebody, you should really watch his website, his YouTubes. They're very, very, very good. Highly recommend. I haven't seen one yet that he's done that wasn't good. His life cycle of a firm video is really, really good. His storytelling in buying stocks is really, really good. He has several of them out there. I actually went through, he has 2 of his classes out there that you can watch the entire class. I've watched 2 of them and taken notes while I was going. So if you want to get my notes on those, really, really good classes. So his New York Stern School of Business, he has his valuation class out there, and I think his corporate finance class out there. It's a graduate level course, so there's some stuff in there that's pretty advanced, but most of it is stuff that's similar to what you had undergraduate. Really good professor. So the proposition, if it does not affect cash flows, it doesn't matter. So if it doesn't affect cash flows or risk, doesn't affect the cash flows or discount rate, it doesn't matter. So you got to figure out, how does this become a cash flow? You might say, well, that's really cool, I really like that, but if they can't monetize it, they can't get money out of it, then there's nothing there. That's kind of what's my question on Twitter. How's Twitter going to get cash? So I don't use Twitter. Y'all use Twitter? Are you noticing the advertising? Is it irritating or is it pretty minor? So, that's when you have advertising, Facebook, I certainly noticed Facebook definitely monetized that. And you certainly saw a huge increase. I didn't notice advertising at all. Now it's just constant. It's kind of a little overkill, especially on their video side. What I love about what Facebook has done on their videos that YouTube hasn't, I don't know if y'all noticed, but man, Facebook knows when to put the advertisement in. Have y'all noticed that? The big drum roll, they're about to give you the big secret, and then suddenly an ad comes out. I was like, man, YouTube doesn't do that. YouTube puts them kind of randomly around in the worst possible places. So they've learned how to monetize that. That's great. The proposition, you got to have a cash flow. You can't always have negative cash flows. That was kind of the question on Tesla. Tesla at some point has to start making money. All right, they started making money. Good. But you can't have them losing money forever and ever and ever and say this is a valuable company. You eventually have to make money. Amazon was like that for a while. You have to eventually start making money. So you can't just say negative, 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 but it's a great idea. Well, no, if it doesn't have a positive cash flow, it's not valuable. And then early cash flow is more valuable than a far out cash flow. That's what we talked about, the difference between value and growth stocks. Growth stocks, you're relying heavily on stuff that's happening way out into the future. So small changes in your assumptions have huge impacts on value. That's why we like a Walmart or Campbell Soup, because so much of their value is here pretty near term, pretty easy to value, not a lot of uncertainty. Those firms, we kind of advantage, they have an advantage, they probably have a little extra value because there's not all that uncertainty 30, 40, 50 years out. The other thing he talked about, which I think is pretty important, is just the common sense factor. If you think Netflix is going to grow 20% a year for 20 years, then take their current customers and grow that rate. And if you come up with a number greater than the population of the world, that's too fast of a growth rate. They're not going to sell to more people that exist in the world. And how big is the world going to get? 10 billion people is about the estimates. So if you forecast that out and they go from, I don't know how many hundreds of millions of customers out to 13 billion customers, you made a mistake. There's no way you can have that kind of growth rate. Same thing with Tesla. I mean, the thing on the EVs, electronic vehicles, I haven't done the math, but I've read several articles saying the market is assuming every EV is successful. That every EV is going to have 100% of the market value. That's just not going to happen. So the market's value every EV to be great in Tesla, and someone's going to lose. And the market's saying no one loses, they're all greatly successful. That's just not going to happen. But then the question is, which one's going to lose? Well, the market's saying, well, this one's great, this one's great, this one's great. That's a tough equation to figure out which of these companies is going to do well and do poorly. So that's the other thing. You look at the market and you just got to ask the question, is it even possible for this valuation to make sense? Is there any scenario you can come up with that makes sense for this firm to be trading as expensive as it is? All right, so let's start. So paper 5, the hardest part of paper 5 is the growth rate, because you're going to do your discount rate in paper 3. So we're going to talk more about the discount rate here a little bit. We've done a lot of it, right? Because we already did the beta discussion. So growth rate. So I'm going to give you 3 ways that you can come up with the growth rate, but we want to tie it back always to the economy, the industry, and the companies. So the 3 ways I'm going to give you, we're going to talk through those: approach 1, approach 2, approach 3. But you always want to step back to some benchmark. Right? The first benchmark is the economy. How fast do you think the economy is going to grow? We'll cover that actually some in paper 3 as you're coming up with your market risk premium. We'll see that a little bit later. So we saw this earlier in the class, right? The economy grows with productivity growth, labor growth, and inflation. That number is going to be somewhere between 4 and 6%. I know recently it's been much higher, but that's because we came out of the disaster of COVID. Even China's starting to slow down. I think China's starting to talk 5% growth. That's a really slow growth rate for China, given the history. Why? Because you can't keep that productivity as high as they've had it. So I think that's in the 4 to 6% range. That's definitely going to influence that terminal growth rate, because eventually every firm is going to grow somewhere in line with the economy or just go out of business. The second thing is your industry. So think in terms of the average. Is this an industry that's growing faster than the average industry or slower? So if I said Valero's industry is what? Faster than average growth or slower than average growth? What would you think? Long term. If you're working for Valero, what's your biggest fear? EVs. Is that going to destroy Valero, do you think? People are saying they're getting in the liquefied natural gas and other things. Are they actually going to start providing energy to the utility industry? But it should be pretty scary for them. We know EVs are going to be growing more and more in use. But is that 5 years out, 10 years out, 20 years out? It's scary. I don't know if that's not, if I were a college student, that might make me leery of taking a job at Valero without really talking to them about their future and what they're going to do with them. What about pharmaceuticals? Is that a growth industry or is that a slow industry? So pharmaceuticals, they make all their money in the US, right? They overcharge us so they can give their stuff away in other countries. Who uses pharmaceuticals? What kind of people? A lot of old people, right? Do we have more old people now than we've had in the past? Certainly a growing population, but how long can that keep going? Most old people eventually do what? Most of them die. Once you die, your pharmaceutical use drops pretty dramatically. So, there's growth there because of the baby boomers. We know every country is aging. We have new technology and other things going on. You have to kind of think through that. Where is that? That's where your demographics come in. What is the demographics? What's population growth? Those kind of things. Utilities might be growth because they're going to be selling more energy to power electronic vehicles. That could be good. But utilities includes coal, gas, also includes turbines and solar. You have alternative energy, is where you can break it up. But think about the industry. Here's where that Porter's 5 comes in. Have you all had Porter's 5 sometime in your career? If not, you definitely want it. Porter's 5 forces, but Porter's 5 forces, buyer power, supplier power, does that sound familiar? You probably had that in some strategy class. What Porter's trying to do is figure out what industries are attractive, which means they have good growth, and which industries are unattractive. So that can be a good way to think about it. Economic moats is another good way to think about that. It really applies more to the company, but you can think about it at industry level, some sustainable competitive advantage. This industry has something, or this company has something that protects them from the competition. So what is it? What do they do that really helps them? So some industries have what we call the platform effect. The Facebooks of the world, where they just have such a corner on the market that it's hard for a competitor to come in. And it's hard to compete with Facebook because no one's on Facebook. Everybody's on Facebook. You start a new business, you got to get people to come onto your platform, and people don't do it because no one's on your platform. That's kind of the Uber and Lyft analysis, right? You'd have a tough time competing with Uber because you need drivers, and what are your drivers going to say? Well, you need customers. What are your customers going to say? Well, you need drivers. How do you fix that? Uber's really good at that, right? They come into a city and boy, they bribe drivers to get onto your platform. Once they get the drivers, then the customers show up pretty fast. So those type of businesses have a huge advantage because it's hard to start from scratch on something like that. So those are the kind of things you're thinking about. And then you get down to the company. And that's where economic mode is really, really critical. Where's your company in this industry? So you got a fast growing industry, but you might have one of the leaders in there. This is something I've not understood because I haven't tracked it, but I don't understand why Zoom won the COVID wars and Skype didn't, and some of the other platforms didn't. UTSA uses, I forget the name of it. I have it on my phone. Was it Teams? Yeah, what is that? Is it Microsoft Teams? So I didn't even know because I go onto the meeting and like, where is everybody? I'm like in the wrong place. And the guy who set it up said, well, let's assume everybody uses Microsoft Teams because you're UTSA. I said, yeah, but I'm an adjunct professor. I don't know what y'all use. So I missed 2 meetings because of that, which, you know, is horrible. I missed 2 committee meetings. It's terrible. But so why did Zoom win and Microsoft didn't? You know, those are tough things to figure out. That's what you're trying to do when it comes to valuation, because that's central to everything, right? And does Zoom have a competitive advantage that can't be easily copied? Could someone else step in and do what Zoom's doing? Microsoft's a pretty formidable competitor, I would think. They certainly have the resources. That's the kind of things you're thinking of. What does Netflix have that's going to keep the competitors at bay? So it's whatever shows they have that they've created, right? They've done their own production now. You know, those kind of things to think about. What does Peloton have? That's their huge advantage. It's their workout people, and I don't know who they are. Y'all probably know who some of these people are, right? These famous workout people making millions of dollars exercising every day. I actually think that sounds even better than playing for the NFL, because you don't get beat up and you make millions of dollars. But that's a competitive advantage. Could that easily be copied? That's the kind of things you're looking for. So what do they have that's, so especially if a company has been growing really, really fast, why are they growing fast? And can they sustain that? Because you know one thing about growth is it attracts attention. Competitors love it. So you're asking for the economic moat. What do they have that protects them from the competition? So pharmaceutical, they have patents, but those patents run out. And it's something else, but pharmaceuticals are really smart at extending patents, but making minute changes to their pharmaceutical products. You know, so they've gotten pretty good at that. But what do you have that protects you from the competition? So moats can be brand identity, platform effect, patents, economies of scale. Right, utilities have a huge advantage in that they have a government protected monopoly, but the downside of that is the government tells them how much money they can make. So they have this monopoly, they can make a fortune, but the government says, no, we're giving you the monopoly so you can't make a fortune, but you're protected. So you have to look through all of those issues. So just because a company's been growing fast doesn't mean that they will keep growing fast if the competition can easily step in. So I'll give you these 3 approaches. You'll probably use at least 2 of these approaches in your paper, in paper 4. And if you use all 3 of them, you might get 3 radically different answers. And that's when you have to step back and say, what's reasonable? A forecast is a forecast. There is no place to go to get a forecast. It's up to you. We're talking about predicting the future, right? No one knows what that is. Who's going to win March Madness? Does anybody know? No one has a clue. Are there people who talk like they know? Yeah. But if I knew for sure who was going to win, would you want me to tell you that? So you could bet on it. It would be really nice, but nobody knows. No one has a clue. Same thing with investing in stocks. It's your opinion, what you think. So even these approaches I'm giving you is not the growth rate of these companies. It's simply some ballpark number that might be reasonable to assume, but ultimately it comes down to what you think. All right, so we'll start there next time. All right, let's get started. Today's a really important day because we're going to essentially do your entire papers 3 and 4, but for another company, not your company. So what we need to do is spend some time on getting growth rates, which is the hardest part of paper 4. It's the hardest part of valuing a stock, and then we'll go back and do discount rates again. So I think what we're going to do today, we're going to value a company. I'll probably do Walmart just because it's a fairly straightforward company. You've got to pick a company. So we have a few students in here that are doing sectors. Have you decided you might do Abbott for your paper 4? You could attend her sector meetings and do Abbott, and we're essentially going to do the paper in her class the next couple of weeks. There's a few others in here. I can't remember who else is teaching this sector in here. I guess one is teaching one. So, I mean, there are sector teams you can join that are going to do exactly what we're doing on papers 3 and 4, but they're going to do it, you know, kind of 101. But we're going to value stocks. So if you want to buy stocks, this is exactly what you do. You got to value the company, try to figure out what you think it's worth. And the most important input you have to get is the growth rate, although the discount rate is pretty important as well. We have a little bit more confidence on the discount rate, but even there, we have a little bit of a range if you're worried about. But the growth rate's the hardest part. So what I'm going to do is, remember on the growth rate, there's 2 of them. There's a long-term terminal growth rate, which we're going to really focus in on when we talk about the discount rate. And then there's the short-term growth rate, how the company's growing now. So most companies right now are probably growing at a different rate than they will when they get to their maturity. And so we've got to figure that out, and that's going to be very different for every single company. I'm not going to tell you how to find that number. I'm going to tell you how to get some sense of what that number might be in a range, what might be reasonable, those kind of things. And then the long-term growth rate, you'll all probably use very similar number that you use in paper 3. So that's where we're going. So let's talk about the short-term growth rate. What growth rate can you expect in the next few years? So I'm going to give you 3 approaches. The first one's pretty straightforward. You just ask, how has the company been growing? Are they growing really fast or are they growing really slowly? The struggle you're going to have is that something called COVID showed up in 2020 that had a huge impact on that. So like with Abbott, they started doing the COVID tests. So their income increased $4 billion just doing rapid tests. Are they going to be doing that next year and the year after that? Kind of depends if we have, you know, more COVID or other pandemics. But that certainly helped them. Certainly Costco and Walmart saw huge increases. Other industries like airlines, cruise lines, they saw huge negative impacts. But actually, you know, if you're trying to pick a company to do, those may not be bad ones to do, mainly because you got a pretty big advantage of seeing, all you got to do is say, when will they get back to their pre-COVID numbers? That's not a real hard thing to think through. So cruise line or airline, you think at some point, 2023, 24, 25, they're going to be back to where they were before COVID. That can be interesting. You got a firm like Exxon, which is benefiting from oil prices being over $100. What are you going to do with that? You might even use a negative short-term growth rate, assuming oil prices, once Russia gets resolved, the oil prices will drop back down to 80 or something. So you might even assume a negative number. So it depends on the company. Every company is different, but we can look at the history, just realizing that history might be a little distorted by COVID, and I'll show you how you can handle that. So we'll start with that one. The second one is a little bit of cheating. But the second one says, let's go out and see what Wall Street thinks. So the second one is, let's go get the growth rate that Wall Street's using, and maybe that's the number we should be using. If Wall Street's assuming 20% and I'm assuming 8%, I might be right, I might be wrong, but I should at least be a little worried. Why does Wall Street think this company is going to do a whole lot better than I'm going to do? So that's the second approach. And then the third approach is the theoretical one we're supposed to cover in the textbooks. And that's just to use the financials of the company. We'll cover that one. It's called the sustainable growth model. I'm not as big of a fan of that one, but we'll use it because the textbooks all teach it. And we'll use these 3 approaches. They don't necessarily, like the first approach doesn't necessarily give you a number. It just gives you some numbers to look at. The other 2 approaches give you a definitive number, but there's a lot of caveats around them. So let's start with this first one, which is just, let's look at how the farm's been growing the last 3 years, the last 5 years, the last 10. And one thing you might do is do these numbers twice. Do it as of today, but even also do it, say, pre-2020. How are they growing before COVID showed up? And then how are they growing today? So where I recommend there, which is pretty straightforward, someone's on the chat. Oh, okay. So let me show you how you can easily do it. And I have kind of an alternative motive here. The library provides Capital IQ. Capital IQ is a great resource for this particular paper, but also if you're not using Capital IQ, you really need to. So this is kind of my way to try to force you out there on Capital IQ. You need to get Capital IQ onto your resume, and this is a real quick, easy way to do it. So how many of you are using Capital IQ in here? That looks like 0. None of y'all have ever used Capital IQ in this classroom. You're paying for it. Why are you paying for it and not using it? Any of y'all paying for a car that you're not using? Any of y'all buying groceries that you're not eating? Why are you paying for something that you're not using? That seems like really bad finance, doesn't it? Plus, a lot of firms use Capital IQ. Put it on your resume. So get Capital IQ. You just go to the UTSA library, databases, click on the C, go down and find Capital IQ. When you click on it, it will ask you well, I'm already in it, so I can't show you that, but it will ask you to register. You have to use your utsa.edu account. You register, you get an account. It doesn't always work the first time. Just keep trying it to work. Eventually, get an account. When you get an account, this is what will show up, and it's a powerful tool. We have the Investment Society has a class that Anthony's teaching on Capital IQ, and I've been sitting in on it. I've just been blown away how powerful this is. I had no earthly idea Capital IQ can do what it does. You're going to have to take a capstone class at some point, right? Do you want to be the hero of your team because you know where the data is? Your team's like, what do we do? What do we do? And you say, oh, I'll just go get the data from Capital IQ. And they're like, wow, thank goodness you're on our team, right? Don't you want to be the team member? They're saying, thank goodness you're on their team versus, boy, I sure hate having this person on our team. You know, which person do you want to be? So Capital IQ will make you the hero of your team. So I'm going to do Walmart. So all you got to do is put Walmart up there. And when you bring it up there, you see all these financials. I'm going to bring in income statement. And I'm going to move it back to go more time. And not only that, but I can download everything. There's a button right there. It just says download. I can click on that. And it takes a little bit because it's a lot of data. I mean, think about it. You're on a capstone team and they need a lot of data. I just produce a lot of data. How long did it take me to do that? A couple of seconds, right? Very, very easy. How much data do I have? This guy again. I've got that page, that page, that page, that page. I've got a lot of data in one click. So I'm going to go to the income statement. This thing is very irritating. Go to income statement. I'm going to hide some rows because it just kind of messes things up. And I'm going to put a freeze frame in here. So there's a couple lines I find really, really interesting here. One is revenue. I'm always curious how fast revenues are growing. That to me is just very, very interesting. And another one, obviously net income. We can even do earnings per share. And then let's do operating income. So just find some ones that you're really interested in. So this only goes back to 79. They could have gone back a little further than that, but it goes back pretty far. You can't do that with Microsoft or some of the others. So what I'm going to do is I'm going to actually calculate a 3-year growth, 5-year growth, 10-year growth, just out of curiosity. And I'm going to do it again. But here, boy, that's the bad thing about hitting the escape button. It brings that back. But here I'm going to do pre-COVID. Because we know Walmart's growth is probably exaggerated right now. They're probably doing better than we really expect them to do going forward. So how do you do a growth rate? This is something you use all the time, right? You take the ending value over the beginning value, raise it to the 1 over n minus 1. It's a formula we use all the time in finance, quite common formula. Now for 3-year growth, I don't do this year over 3 years ago. That would be 2-year growth. All right, because that would be growing from here to here and there to there. That's only 2 years. So if you're doing 3-year growth, your base case is 4 years ago. Everybody understand that? So if you're doing 3 years growth, you do today, and then you compare it to 4 years ago. But we do raise that to the 1 divided by 3 minus 1. And there's our growth rate for the last 3 years. Now that doesn't sound very high, but that's revenue. That's a pretty strong growth rate for revenue. I'm going to do the same thing for 5 years. So for 5 years, I did today, and then I divided by 1, 2, 3, 4, 5, 6. Raise that to the 1 over 5 minus 1. Not real strong, but still without COVID, we'll see with pre-2019, I mean, pre-2020, what that does for us. And then 10 years, that divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Raised it to 1 divided by 10 minus 1. And that one really looks weak, but that's Amazon and everything else going on, right? I mean, this is a pretty tough environment. Now, it's a much worse number than it looks right there. That 2.5 looks like they're just barely keeping up with inflation. But how do they barely keep up with inflation? Well, they added several hundred stores. So that's pretty pathetic, isn't it? They added all these stores, and even adding all these stores, their growth in revenue is still only 2.5%. So it hasn't been great for Walmart because they're competing with online. And this is with COVID. So let's see what it is without COVID. So instead of using, let's go back. Let's see if we can see the COVID jump. Yeah, this says 2020, but there it's January 2020. So that's pre-COVID, isn't it? So we're going to do AQ. We'll do AQ over, I can't do that in my head. M maybe, I don't know, AQ over AM. AQ 1, 2, 3, 4 over 8N. So if you look at it, the 3-year growth with COVID is 3.6%, without COVID is 2.5. So COVID did have added about a 1% to the overall growth rate. That's per year. You can do the same thing with 5 years. So 2020 divided by 1, 2, 3, 4, 5, 6. And that's much lower. And then probably kind of scary, this last one. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Actually, it came back 10 years, doesn't look too bad. The 10-year is the same for both. Whether it's whether it's pre or post COVID, but you have a lot more years in there. Nice thing about this is once we have this loaded, we can do that all the way down. So operating income, we've got it. Pretty straightforward. We just copy the formulas down. What do you notice with the operating income? Huge difference when you do pre and post COVID. So Walmart has been struggling with the competition. You look at earnings per share. Earnings per share is up quite a bit. Ah, boy. Zoom, that was a bad decision to make the escape key, how you get out of that. Now, is it possible for earnings to grow 4% and earnings per share to grow 6%? Well, definitely. What are firms doing? They're buying their stock back. When you buy your stock back, what happens? Your earnings per share grows faster than your earnings. So it's certainly possible. With Walmart, the 29% is, there's something else going on here. It might be taxes. There's probably some other line in here that's just really, maybe it's probably some of these unusual items or something going on that's causing a huge jump beyond just COVID, because the operating income is only up 5.72%. Could be interest expense. Interest expenses down. That makes some sense. They don't have any major unusual items. They had a major loss on asset sales 3 years ago, so that's somewhat distorting it. So there are some things going on with the earnings per share. I did do basic earnings per share. I don't think it really matters which of the earnings per share I use. Diluted doesn't seem like that makes much difference. So the last 3 years they've grown 29%, but that's probably something going on with some unusual items. There's probably some COVID going on with that. Longer term, their earnings per share is pretty decent growth last 3 years through 2019. Pretty weak growth long term. So when I look at the history, this is not a rapidly growing company. This isn't Alphabet or Zoom or Tesla. This is a fairly mature company. So this company might be a little boring because this might be a company that is already at their terminal growth, which means their short-term growth and long-term growth is the same. That makes it so that may be something that will influence how you pick your company. It's much more interesting you pick a company that's growing a little faster right now than you expect them to grow in the long term. So that's why Campbell Soup's a little boring. Campbell Soup is probably at their terminal growth. There's probably not a whole lot of radically new things they can do. So your long-term growth and short-term growth is all going to be the same. So Walmart, you have to think about Walmart. What can Walmart do that can generate more growth? Can build stores. That's not a great way to grow earnings because that's a really expensive way to grow earnings, right?
They do acquisitions. That would
Acquisitions, they've done some of that, haven't they? That's a real expensive way to get growth, but they did Flipkart. They've done jet.com. I think we talked about that more people are using walmart.com to buy stuff just because the store is close by. So the acquisitions is helping what? Home delivery, curbside. There are some things that they're doing and are buying technology, and we talk about Walmart as being, getting taken down by Amazon, but I think Walmart is still a pretty impressive competitor. They're not stupid people. They're smart people and they know what they're doing, but they do have a really tough competitor. What else could you do? At some point, they can't build any more stores in the United States. So then what do they got to do? Overseas, right? Could Walmart do that? They've had great success, or maybe horrible success in Latin America. They're somewhat taking over Latin America. They've got some good competitors down there, but they're taking over Latin America. They haven't been real successful in Europe. They struggled. They've been trying to get into India. They haven't done well there. So they've struggled, but there is some possibility they could do well there. What else can you do? You can broaden out into other things like credit cards. They've talked about a credit card. They've had some tough time regulatorily getting a credit card, but there are other products and services. Probably on the financial side is the most likely thing there that they could do. Someone was talking to me about the lobbies of these places like Costco and Walmart, that they're really changing. I've noticed it with HEB. So they're almost turning themselves into a real estate company where they're leasing out. I don't know what Walmart has. I haven't been to Walmart in quite some time. I know there's like Subways in there, but do they have anything new, interesting? I noticed HEB has the financial company and they have a few other things in front. Does Walmart do anything interesting like Costco is? Anything healthcare related? Are they having any kind of health clinics there? So they, huh?
They have a Charlie's.
So food, yeah, food places, yeah, that's about the only time I go to Walmart when I'm traveling is I think there's probably a Subway in their lobby and so, but those are minor things. They have tried new store plans, the smaller Walmart to try to take on Family Dollar and Dollar General, but it doesn't look like they're gonna do that very well. So the online, that's probably the online, I think, is where they have the hugest advantage over Amazon is that they have so many stores. But does that give them growth or does that just keep them from losing growth? Which is it? How many of y'all are like, man, if Walmart does this, I'm back to Walmart. I'll never use Amazon again. Have you heard anyone say that? Once Walmart does this, I'm done with Amazon. I'm only using Walmart. You probably haven't heard that conversation too frequently out there. I mean, it's a huge advantage, right? And especially if home delivery gets a lot better with DoorDash, Uber, and drones, if we can get drones. And there's certainly some technology coming along. I do think on the financial side, I don't think it's going to be cryptocurrency, but I do think, I was listening to one blog on Visa. If I were Visa, I'd be really, really worried. When I was a kid, we had credit cards for everything. So you had your gas credit card, you have your store credit card, you had your Dillard's credit card. And then Visa, MasterCard came around, everybody just consolidated all of that. Well, now the thought process will unconsolidate all that. And so you walk into Walmart and you have a Walmart credit card that's on your phone. And Walmart says, you use that card, we'll give you a 2% discount. And why would Walmart do that? Because now they don't have to pay Visa the 2%. Would you get a Walmart card if every time you went to Walmart, you got everything 2% cheaper? And Walmart just said it. So, maybe it's 1.5% cheaper and they pick up at 0.5% and they essentially make themselves a bank. Could that happen? That would, in the past, having 6 credit cards, one for your gas card, and it was a pain. But if it's on your phone and automatically happens when you walk in the store, it says, yeah, that's not that big of a hassle for me. So there are some things Walmart has going for them. Their biggest thing, I think, by and far, is the number of stores. They've got the country covered. What is it? 90-something% of Americans are within 10 minutes of a Walmart. That's an impressive presence that few other people can handle. So that's what you're thinking about. What could be going on with this company that could somehow give it some growth rate better than just this kind of mediocre 2 to 3% that they've been getting? So that's the kind of thing you're going to write about. So the historical growth recent growth has been strong because of COVID. Longer term growth has been barely above inflation, even with all the stores they're adding. Pretty negative discussion there. But you can definitely do this using a capital IQ. You've got the data there. You can put the growth rates in there. So the growth rates, the last year divided by 4 years prior, raised it to 1/3 minus 1, that gives you the CAGR, and that gives you the growth rates that you need for the paper. So easy approach. I say here rolling 3 years. I don't recommend that anymore because you tend to get some really bad numbers. It's like to look at the growth rate over 3 years is 3 years, 3 years, 3 years, 3 years. So I recommend just stick with what I just did there. I did 2 different 3-year periods because of COVID, so you might do something like that. But it's unlikely. I mean, if a firm's been growing 3 to 4% the last 10 years, and you're going to argue you're going to start growing 20%, you better have a really good write-up where you're explaining why suddenly they're going to be growing really fast again. All right. I mean, it's pretty unlikely Walmart's suddenly going to become this high growth company overnight, other than COVID. All right. Questions on growth rates and CAGRs? So,
When we're looking at growth, are we looking at earnings growth or like
Well,
valuation growth?
I do, well, we're talking, bro, you're not valuation. So valuation is what you're trying to produce. I'll look at revenue growth and earnings growth. Earnings growth can be operating income, EBITDA, it can be earnings per share. What we're really looking at theoretically is dividend growth. Dividend growth can be a little messy because that's somewhat of a political thing. The firm, they kind of control that. So we tend to look at earnings per share growth, but then assume earnings per share growth is going to be the same as dividends growth. If their earnings are growing 5%, they'll eventually grow their dividends 5%. So the main thing, if you had to pick one number, it'd be earnings per share. Now, the problem we have with earnings per share is what? They've got a bunch of them. You got basic with that extra items, diluted. For most of your firms, there won't be a big difference between those. Y'all remember diluted earnings per share from your accounting classes? It's kind of a mess, right? Really complicated formula for not much value to it. I would just use the basic earnings per share, but do look and see if there's a radical difference between those. I mean, it's not that difficult, right, to just put this all the way down. So for Walmart, it's not a big difference. And then they have normalized. Who knows what normalized is? So in this case, normalized is probably they fixed something in 2019 because it looked like they had some unusual items. So normalized might be a number to look at as well. The problem with normalized is like who's normalized? Who's deciding what's temporary and what's permanent kind of stuff. So, but you see, we do get that, and their normalized is actually higher than diluted, but the biggest thing is their normalized 2019 is much higher, probably because of these massive sales of subsidiaries. So the accountants make it complicated. We say earnings per share, and they say which one. We got 8 of them. So okay, well, let me look at all of them. All right, so give yourself some historical perspective. The next thing is something you don't want to over rely on because your boss is hiring you to figure these things out. And if all you do is go out and see what the market thinks, then why are they paying you? So approach number 2 is what I call the PEG ratio approach. So we're going to talk about PE ratios here starting probably next week sometime. A PE ratio is the price of the firm over its earnings per share. Y'all probably heard of the PE ratio. A high PE ratio is an expensive stock. A low PE ratio is a cheap stock. Well, there's also something called a PEG ratio. What the PEG ratio does is take the PE ratio, the forward PE ratio, and divides it by expected growth. And what you're trying to do is say, okay, their PE ratio is high, but it might be high because they're growing really fast. Why don't we take their PE ratio compared to their growth rate, and we kind of adjust it, and we got a good number. What that means is once you get your firm's PEG ratio and get their PE ratio, you now know what the market thinks their growth rate is going to be over the next 5 years. So that's somebody's number. You might argue that, well, Wall Street probably knows this company better than I do because I'm just looking at this company right now. So maybe I should give them some credence. So that means your expected growth is just you take your PE ratio divided by the PEG ratio, and that will give you your growth rate. So let's do that with Walmart. So with Walmart, all you got to do is go to statistics and not the current, but use the last quarter here. The current sometimes gets a little distorted. For Walmart, it looks okay, but it's a little distorted. But their current PEG ratio is 2.86. Now, is 2.86 good or bad? Well, if you go out and Google PEG ratios, there are PEG ratio groupies out there. There are people who think PEG ratio is all you need. And they swear that you buy companies whose PEG ratios are below 1 and you avoid companies whose PEG ratios above 1. I don't believe that at all, because that ignores the fact that PE ratios are very sensitive to interest rates and inflation. And because interest rate inflation's change, PEG ratios should change. But there are people that argue that. And then we need to get a PE ratio, but it's not any PE ratio, it's the forward PE ratio. What's the forward PE ratio? So the PE ratio is their price divided by their earnings the last 12 months. The forward PE ratio is their price a day divided by their expected earnings per share the next 12 months. All right. We use the forward PE ratio because that's what the PEG ratio is based off of. If the PEG ratio is based off the PE ratio, we'd use that, but it's based on the forward. And you can even see that in the numbers. So here's the forward PE ratio, 20.96. So what is the expected growth? You just take PE ratio divided by the PEG. And you have to divide by 100 because it's they don't use the percent. So that's all you do. PE ratio divided by the PEG. And they get 7.33%. That's a pretty high number. History doesn't really support a number that high, right? Especially if you take COVID out of that. So why does the market expecting such strong growth rates from Walmart? We don't know, because we don't know who these people are. We don't know what assumptions they're making, what they're thinking. But there's a number, 7.3. That's the number from 5 years. Now, what I'm not sure about, and I've never seen this in these calculations, is that the average over the next 5 years? Is that the median over the next 5 years? Is that next year going to a number over 5? What is it? We don't really know what the trajectory is. One thing you can do, though, if you'd like to, is you can go into Bloomberg and do the EE. Bloomberg is EE is expected earnings. And if you want to, you can actually go on Bloomberg and see what the market thinks by looking at the actual numbers. And they'll show you Walmart's earnings per share expected next year, in 2 years, and 3 years, and 4 years, and 5 years. You can use that to figure out a growth rate. You might get a different number because that might be a completely different group of people than the group of people doing this ratio. All right. So you do have other access to other information. You don't want to over rely on that because you should have your own opinion, but you can certainly go out and say, hey, I want to just look and see what the market is assuming right now. This by itself might tell you quite a bit, because if the market's assuming Walmart's going to grow 7% and you think there's no way they're going to grow more than 4%, that right there tells you might want to avoid Walmart stock if the market's that optimistic about it. All right. That's the easiest one of all to do. What that means, though, is your firm has to have a forward PE. Why would your firm not have a forward PE? You have to have two things, a price and earnings per share. Every firm has a price that's publicly traded, so why wouldn't you have a forward PE? Well, because your earnings are expected to be negative. So don't pick a company who has negative earnings the last 12 months or the next 12 months. That just doesn't work, all right? So make sure they have positive earnings. Walmart obviously has had positive earnings, so that gives them a PEG ratio, gives them expected growth about 7%. All right, I'm not going to go in the screen show, so I don't have to keep getting out of this thing. Any questions on the PEG ratio? Real easy to do. It's like a give me point on the paper. You just go grab it. And it's not a bad thing to bring up. If you're in an interview and you're talking about a stock and say, yeah, their PEG ratio implies a 12% growth next 5 years. That's an impressive thing for an undergraduate student to say. So these are not bad, easy skills I have to impress. All right, let's look at the next one. So this is called sustainable growth. I don't like the term sustainable growth. I think it has a lot of flaws in it. But what this model says is firms that retain more earnings are going to grow faster than firms that pay out large dividends. So the argument is if you retain more earnings, you're going to reinvest in the firm, you're going to build more capacity, you're going to grow faster. If you pay out a lot of your earnings, you can't grow fast because you don't have anything to build. So the argument is the higher the retention, the more they retain, the faster the growth, the higher the payout, the slower the growth. And they tie it to a very mathematical thing. And this formula is exactly correct. There's no doubt this formula is correct, but it assumes constancy, that stuff never changes. So this formula is actually perfectly correct as long as the firm never changes. It has the exact same earnings forever. This formula is correct. The problem is firms change quite a bit. So the sustainable growth, there's a formula, very easy formula. Sustainable growth is the firm's ROE. What is ROE? Return on equity times retention. Retention is what? The earnings per share times 1 minus their payout. Because their payouts, how much they pay out, how much do you retain? 1 minus how much you pay out. All right, so ROE times retention. You'll see this formula in a lot of textbooks. So we'll work through the numbers. I think these might be Walmart numbers, so we'll just update them. So if a firm has earnings per share of $4.74, these do look like Walmart numbers, and dividends per share of $1.59, then 474 minus 159 means they retain $3.15. So they made 474. They paid out $1.59, so they retained $3.15. What percentage did they retain? $3.15 over 474. Are they retained 66%? So if their ROE was 10%, they retained 66%. Then their expected sustainable growth rate is 6.6%. All right, so there's the theory. That's how I was taught in my undergraduate. So this has been around for decades. This is not something new. Probably Benjamin Graham probably used this pretty long time. And then some guy named, boy, I just forgot his name. A famous guy in finance, his name will come to me here pretty soon. He said, well, if that's the case, we can go back historically, and firms with high retention rates should have higher growth rates than firms with high payout rates, right? We should just go back and empirically test that. And what did he discover? He discovered that firms with high retention rates have slower growth than firms with high payout rates. He found the exact opposite. Does that mean you throw this out? I would argue no. I think the theory is correct here, but why would firms have higher growth when they pay out more and lower growth when they retain more? Well, I think it's because of geopolitical things going on. In 2008, firms' retention rates went up dramatically. Why did firms retain so much in 2008? Was it because growth was great and they were reinvesting in high growth? What was happening in 2008? Financial crisis, right? Why were they retaining earnings in 2008? Because they were scared to death. They weren't retaining earnings because they were growing fast. They retained earnings because they were worried they're going to go out of business. Why do firms pay out a lot? Because they're confident things are going well. So there's that side of it. So it is true a firm with a high return on equity is going to grow faster if they retain more than if they pay out more. But usually firms with high return on equities are very confident. They pay higher dividends. So there's that thing going on. I think the theory is correct, but because of the nature of recessions and recoveries and those kind of things, and how firms make these payout decisions, I do think there's a little bit of noise that really distorts it. But we'll use this. So far with Walmart, we need a return on equity, and we need their payout, and that will give us the retention, and then that will give us the sustainable growth. Now, we can get this from capital IQs. So let me show you in capital IQ. They don't have it on that page. They do have the payout probably in here somewhere. Right, so y'all see it there, return on equity. So it's on the ratios page. So return on equity. Their last return on equity was 15.5%. But I'm going to look at the last few years because I want to make sure that's not just a ridiculously unreasonable, because if it's 80%, but it's been 10 to 12%, you might kick out that last year. So 15.5, I'm going to look at the average for the last 5 years, and I'm going to look at the median. What's the advantage of the median? it's not messed up by outliers, right? The average is messed up by an outlier. Like Tesla, this Tesla has a negative 813,000% ROE. That's really going to mess up the average, but the median will kick that out. What do you notice about the median? Exact same as the last one. So 2022 is probably a perfectly fine number to use with Walmart, 15.5%. But if your firm's all over the place, you know, try looking at the last few years, look at some averages. I'm going to use 15.5 for them. Their payout, I'm going to see if I can get that from them. I'm not real sure where they have that. The dividend per share versus the earnings per share. Here's the dividends per share. That's not dividend per share. Yeah, I don't know why they call that dividend per share, because it's most definitely not dividend per share. There's earnings. Oh, these are growth rates. I'm sorry. There it is. Dividend. No, again, it's a growth rate. We don't want growth rates. We want the actual number. Altman Z. So let's go back to income statement and see if it's in there. We know we have earnings per share in here. Do they show? Well, here it is. They have it. Okay, so yeah, I knew they would have it somewhere. I don't use Capital IQ as much this summer. I'm going to spend the whole summer getting in detail on Capital IQ because I find it really cool. So here's their payout ratio. You can see it's on the income statement. I'm going to do the same thing here. I'm going to do the average the last 5 years and the median last 5 years. And we really need the median this time because look at what happened back in 2019. They paid out 92%. So the median is 45. Again, 2022 is 45. 45 sounds like a pretty decent number for them. A typical stock in the S&P 500 pays out about 40%. So 45% is pretty typical. Right? What if you pick a company that doesn't pay dividends? Then you need to come talk to me because we're going to have to figure that out. You can't have a retention of 100%. That's fine, but we can't use a dividend discount model if you don't have a dividend. So I'll have to give you a substitute number. So make sure you can pick any company you want as long as they have positive earnings and they're paying dividends. So that's fine. But if you want to pick a company that doesn't have those characteristics, you're going to have to come check with me to make sure we can get it to work. We can substitute some numbers. All right. So what is our retention? Our retention is just 1 minus 45%. So they pay out 45% of the earnings. They retain 55%. So what does that mean? Their sustainable growth. You just take ROE times retention, and you get a higher number, 8.53. So historical suggests a 2 to 3% growth rate. The PEG ratio and the ROE sustainable growth says something in the 7 to 8.5% range. What's the right answer? That's up to you. If you email me, Professor, how do I get my growth rate? I don't know. You got to figure that out. It's like asking me, Professor, where will I be working in 7 years? I don't know that. I don't know where. You know, you're forecasting the future. It's your opinion. Are there wrong answers? Yeah, if you assume 47% for Walmart in the next 10 years, I think that's a wrong answer. I don't think any reasonable person thinks Walmart's going to grow that fast in the next 10 years. But technically, there are no wrong answers. It's your opinion on whatever you think. There is a wrong answer on the long-term growth rate that we'll see. So what growth rate can we use for Walmart? Historical suggests something in maybe the 3.5% range, if even that. Who knows? This is when you look at the three numbers and you got to make a decision. You can ignore all three of them and use your own number. You can average the three of them. You can take the middle number. You can kick out the outlier and use the average of the other two. Whatever you pick, you're going to have some justification for it. All right, so I can certainly make stuff up. Creative writing. So for Walmart, I'm going to use 7.5%. Why? Curbside plus Latin America growth. I don't actually believe that because Latin America is really struggling right now with some really kind of difficult elections going on. So I'm not sure this is the best time to be trying to grow in Central and South America, but I'll go with it. That'll be my argument. Some argument that justifies. If you don't know, then flip a coin and then get your growth rate and then use your creative writing, come up with something. We're not trying to buy a stock here. We're trying to go through the process. So this is where you spend a lot of time. You have to really understand the company and figure out what is going on with this firm. In reality, you're going to look at how many stores they're adding, how many square feet they're adding, what they are doing overseas, what is the curbside doing to their sales, what is the online sales versus is the online sales adding to their sales or is it just cannibalizing existing sales? You go in that kind of detail. What else are they doing? And you just try to figure that out, right? A lot easier for Walmart than it is for Google. Would you agree? Because Google's doing a million things. Disney is a very difficult company because you got to do the theme parks, the cruise lines, the movies, the merchandise, you know, and then the stream, very, very difficult. And then Netflix, everything, you know, I mean, not Netflix, ESPN, just really, Disney is a very hard company to come up with. Any one of those business lines, cruise lines, theme parks, any one of them is really difficult. Any one of them are as difficult as Walmart. And then they got 5 or 6 of them. So it gets pretty tough. You do your best, you figure out something that makes sense. So a one product company is a lot easier to talk about than a multi-company. So don't do Berkshire Hathaway, that's just practically impossible. Don't do General Electric, practically impossible. Some of these firms are just really, really difficult to do. All right, so I'll use 7.5%. All right, so that's essentially what we're after in this part of the paper is, and it's the most important part of the paper, is get that growth rate you're going to use. All right.
So for papers 2, 3, and 4, do you want this to stick with one company or different?
No, you can use, well, 2 could be a different number company than 3 and 4, definitely. And especially on 2, you're picking one of the ones I'm giving you. If you want to, you certainly can use the same company, but there's not a lot of overlap. I don't think there's any overlap between 2, 3, and 4. So doing 2 is not going to help you do 3 and 4s. The only advantage might be combining them all in one paper to put on LinkedIn. You know, you can certainly do that, but there'd be an obvious break because one's focused on the past and the other one's focused on the future. All right, so that's that short-term growth rate. I'm going to use 7.5% for that. Then the question is, how long can Walmart keep that 7.5% going? I don't actually think they can do it. So, but that's where you're going to talk about. I just said curbside pickup, online. I probably should put online on there. Curbside with online and Latin America. I would be looking at those. So I might look and see, okay, how saturated is Walmart in Central America? How saturated are they in South America? What countries are they not in yet that they might get into? You know, could you find that data? Yeah, that data is out there. For Facebook, you can figure out what percentage of US residents are on Facebook, what percentage of people in India are on Facebook, what percentage of people in China, which might be 0, are on Facebook. You can go country by country by country, and you can ask the question, what if India gets to half the level of the United States over the next 5 years? You can certainly do that. And Facebook's growth is going to be entirely on users because the more users they have, the more ad revenue they get. It's a one-to-one link. So Facebook, you could sit down and go country by country by country and figure that out. Tesla, I would probably look and say, okay, what percentage of Americans have EVs? What percentage of Americans will have EVs? How much of the market will Tesla have? Who are these competitors? And I would go out and say, okay, EVs are going to dominate the US car market in 10 years. Yeah, is that too fast? in 20 years. In 20 years, they're going to be 70, 80% of the market. Tesla's probably going to be 50% of that market. I know how many cars there are in the United States. Yeah, that's the kind of thing. I got that autonomous vehicle thing on the other side of that. That's kind of a concern. And I got Uber and Lyft, you know, so no one really knows, right? But you got to figure those out. I've also got SpaceX and all these other stuff going on. So you got to, you know, you guess, you make something up and you try to figure out where these companies are going. If you were doing blockbusters in their heyday, you're probably thinking, wow, this firm's growing way fast. You're not thinking about Netflix at all. So sometimes things come right out of left field. Doesn't mean you're wrong or you made a mistake. It just means you didn't know the future, which is true for all of us. All right. The goal is not to be right 100% of the time. In fact, if you're right about 52% of the time, you will do really well in finance. You don't have to be great. You just have to be slightly above average and you do really, really well in finance. But most people aren't slightly above average. Most people are average or below. So you don't have to be great. So you might forecast Walmart and do a horrible job on it, but you do a great job on Tesla. That's the goal, is you have a process and it makes sense. And on average, you're a little bit above average over time. So for Walmart, I don't know. I'm going to use 7.5%. I'll say timing. I'll give them 6 years. Now here's where almost everybody loses points on the paper, is they don't explain where that 6 years came from. Again, creative writing. Why would I talk about that? Well, I might say, you know, curbside right now is only about 2% of the market. Where could I get that? You want to add some strength to your paper? Do y'all use Statista? Isn't that a great thing? What can I type in Statista? I'm going to type curbside. I don't know what's going to come up, but I'm going to type curbside. Do you think anything will come up? We'll see. Curbside pickup usage behavior United States. What was I just looking for? Curbside pickup behavior United States. There it is right there. Is it any good? I don't know. I'll click on it. Is this something I could put into my paper? Maybe. There's a survey. I have used it. I have used it during the pandemic, prior. I plan to use it after pandemic. I don't know how these add up to more than 100%, don't they? I don't quite understand this. Why did 20% use it before the pandemic, but only 19 plan to use it after pandemic? Was it like a bad experience? I do know people who've had bad experience with curbside. I've not used it yet, but would like to try it. I am not interested in using it. 32%. How many of them are correct? They'll change their opinion. Right? It's kind of like the people during my age, oh, I'll never use a cell phone. Why would I want to walk around with a phone? I want to get away from them. They all have cell phones today. So people will start using it. It's more convenient. Right? It's going to happen. So, but that's interesting. That's not quite what I'm looking for. What I want to know is what percentage of grocery store sales are curbside today? Because then I'm going to say, well, I think it I could kind of use that chart and say, well, maybe curbside is going to be 20-25% of the market. And is Walmart is going to have any advantage on that over Amazon? If that's the case, I think Walmart's going to do well there. So over the next few years, they're going to pick up some business from Amazon and some other, you know, who knows, whatever argument I make. And they get pretty specific in their analysis. So I'm going to use 6 years, and I'm going to have some justification. Maybe it's curbside, maybe it's online, which I'm combining those two, again, Latin America. But I got to have some argument for why I think that's 6 years and not 5 years and not 7 years. All right, try to find something. If you can find some kind of chart that supports that, that's the best thing of all. Some basis for it. And that's true in your job as well. You have to have some basis. You can't just have an assumption of 6 years and just kind of pulling the number out of thin air. All right. Everything we do in finance has to have some justification for it. All right. So I've got a couple of my numbers here. So we're going to, on the long-term growth, we're going to come back to that because we're going to use this for paper 3 as well. But it comes back to what we talked about when we were talking about stocks. The long-term growth of companies is going to be closely tied to U.S. economy. The U.S. economy is productivity growth, labor growth, and inflation. So we're going to come back to that and use that. So that part you're going to use in paper 3, and then you'll just bring it forward to paper 4. Okay, so that one's fairly straightforward. All right, so we'll come back to that one because we're going to do the discount rate. So any questions on the growth rate? A lot of this really is creative writing. So you may not even believe what you're writing. You might say, hey, I could use 5%, I could use 8%, I could use 10%. Flip a coin, pick one, and then make it sound good. Do we do that in finance? I've done that in finance. It's not that I didn't believe what I was saying, it's just I wasn't nearly as confident as I was making it sound like, but that's part of finance, is sounding a lot more confident than you really are. I don't believe in that, but sometimes you got to do that in competitions and in other things. In real life, you need to be a little more honest when you're at the job. Say, you know, I really don't know. What data can I get to give me more confidence? That's the better way to think about it, rather than convincing yourself you got it figured out. But when you're presenting it, put the confidence in there. All right, so we're going to step back and do the discount rate, mainly because this long-term growth rate is part of the discount rate. So we can kind of, kill two birds with one stone? Whatever that saying is. All right. So for paper 3, so we're jumping back to paper 3. For paper 3, you need a discount rate. We're going to use the capital asset pricing model. All right. I'm not saying it's the best model, but it's what we're going to use. It's the one you've had in a few classes already. It has 3 inputs: the risk-free rate, the market risk premium, and beta. We already talked quite a bit about beta, right? We've already got beta down. I'll do it again, but we'll talk about beta more quickly because we've already done that. So the first thing we have is the risk-free rate. So theoretically, the risk-free rate is the return you can get with absolute certainty of the lowest risk asset out there. We've historically said that's the U.S. Treasury. But which U.S. Treasury? Is it the 1 year, the 5 year, the 10 year, the 30 year? Any of those are fine, but tradition has always led toward the 10-year Treasury. Why the 10-year? Well, shorter term rates are much more volatile, so it means your discount rate's changing a lot. The 20 and 30-year rates are really unreliable because it's a very supply-demand type of market. There's very specific type of investors that buy 30-year bonds and 20-year bonds. And so when the supply or demand gets out of whack, those two numbers can get pretty uncertain. The 10-year is just probably the single most important interest rate in the world. It's the only interest rate on Yahoo Finance. It's used to price mortgages. So 10-year Treasury is the most common number. All right. So some people say that it's artificially low right now. Even today with it kind of got up to 2.5. It's dropped down quite a bit the last couple of days. But getting up to 2.5, still say that's pretty low given that inflation's clocking in at 8, 9, 10%. Who wants to lock in 2.5% for 10 years when inflation's so high? But obviously, we're assuming inflation will come back down, and you'll get 2.5% and inflation will come back down. So in your paper, you can use the 10-year Treasury, but you at least need to make some comment about why you think that's okay. You're not worried about it being so low. And I've given you some help in the class notes. Dr. Damodaran, he writes extensively on this. You can steal some of his stuff as long as you quote him. He believes just use the 10-year Treasury without any adjustment. There's nothing you need to do to adjust it. His argument is that is what it is. The 10-year Treasury is what it is. It is the risk-free rate. It is what you can do today. No reason to normalize it. I used to be normalizing it, but don't do this on your paper because I don't believe this anymore. I did that back when the 10-year Treasury was really, really low, like 1% or so. It's not that low anymore. So there's 2 approaches I would recommend. One is use the 10-year Treasury and then quote Dr. Damodaran and why he thinks that's okay. And you can find him. It's so easy. His name's spelled just like it sounds, Damodaran. You can just do Damodaran on risk-free rate. And there it is right there. He even has the risk-free rate by country. So if you need a discount rate, let's say your capital, your last finance class, you need to value something in Brazil. There you go, right there. There's your discount rate for Brazil. You need to add an extra 2.97% to your discount rate because it's Brazil. Why? Because Damodaran says so. You probably want to read and say why he says that, so you have something to talk about. But he says if you're going to value a stock in Brazil, use the capital asset pricing model just like you normally would, and then add on top of that an extra 2.97%. So this is all free. Now this might be dated because he's retired. This is, well, it's pretty good, isn't it? January 2022, so it's not that radically off. It's pre-Russian invasion, but it's still out there and pretty recent. So he provides that. You don't have to have it by country though, because we're doing US stocks. So he has the discussion in there. Here's a whole paper, probably dated. He doesn't put a date on it. That's pretty bad. But his argument is just use the current 10-year treasury. All right, so there's one approach. So find something, if you're going to do that, you can quote from him. The second approach, which is the approach I still use, although I'm getting closer and closer to just using the 10-year treasury. As it gets closer to 3%, I'm somewhat comfortable with that. However, here's my argument. It's not so much that the rate's too low right now, it's that there's so much unusual things going on right now. High inflation, the Fed's raising rates, we got the rushing prices, all kinds of stuff are going on. So it just seems really messy right now. So the bond market's like dealing with all these issues. So there's something called the forward rate, where the bond tells you what they think interest rates will be in 5 years. So you could use the forward rate. I actually went and got the forward rate. You can get it right off of Bloomberg. Here's the forward rate. So if you want to know what the bond market thinks the 10-year treasury rate will be in 5 years, there it is right there. 2.3763. You can see why I'm not all that picky on it anymore, because they're almost the same. A few months ago, that wasn't the case. A few months ago, the forward rate was much higher than the current rate. Right? I had a student ask Damodaran about my approach with the forward rate. He said, yeah, you could do that, but it's not going to give you a radically different answer. At the time he said that, it did give a radically different answer. Today, it doesn't. They're almost the same. The current 10-year treasury, this is a few days old, is 2.4%. The market's expecting it to be about the same. So right now, the two approaches give you essentially the same answer. Why? Because the yield curve is really flat. With the yield curve flat, they're essentially saying they don't expect rates to rise or fall. They're just going to stay where they are. When the yield curve is steep, the bond market's telling you that they think interest rates are going to rise and that the 10-year will be higher. So there's the other approach. How do you calculate this? Where the current 5-year is 2.5016. The current 15-year is 2.4212. You make these percents. Any of y'all know how to do the forward curve? Y'all done it before? Who's done a forward curve before in here? Right, so learn how to do the forward curve before you graduate. It's really powerful stuff. So what the forward curve says is, this was the 5-year, right? Boy, with the yield curve inverted in places, it's a little tricky. There's the 5 years, there's the 15 years. What the bond market's saying is you can buy the 15-year bond and you lock in 2.42% for 15 years. Or you can buy the 5-year bond at 2.5% and in 5 years buy a 10-year bond, and you should be indifferent between those two transactions. What we don't know is what the 10-year rate's going to be in 5 years, but the bond market's telling us. And here's how they do it. Now, you may get a slightly different answer than Bloomberg, because I think they adjust for the compounding. I'll have to check and see. But essentially what they say is, let me invest at that rate for 15 years and compare that to investing at this rate for 5 years. If I take those two things and raise it at the 1/10, that will tell me what the bond market thinks the 10-year rate will be in 5 years. That's called the forward rate. And if you want that rate, you can buy it today. All right. If you think the 10-year rate's going to be higher than that, what would you do? I would buy the 5-year. I would short the 15-year. If the 10-year is higher than that, then I'll make a lot of money in 5 years. If I think the 10-year rate's going to be lower in 5 years, I would buy the 15-year bond, short the 5-year bond, and I'll make a lot of money in 5 years. So it's kind of cool, I mean, that you can actually invest in the future. If you want to buy a 10-year treasury in 5 years, you can do it today and lock it in. You can, I mean, isn't it cool that you can bet on the future? If you disagree with the bond market, not today, but you disagree with the bond market, what it thinks is going to happen in 5 years, you can actually bet against them today. And if you're right, so what do you think the 10-year treasury is going to be in 5 years? Higher than 238 or lower? Anybody think higher? It's been pretty low for several years, right? Some people think we're experiencing the Japanese effect where you have low rates for a decade or 2 decades. If you have a strong opinion, you think, man, the 10-year treasury is going to be 3.5%. That's the case. Buy the 5-year, short the 15-year. You'll make a fortune in 5 years. But what if the 10-year is at 1.5% in 5 years? You're going to lose a lot of money. All right. So I like the forward curve. Right now, it doesn't make much difference because it's giving you essentially today's 10-year. So the 10-year in 5 years, how close is it to mine? 2.3763. What did I get? Yeah, I got a little bit higher number, but I think they adjust for the 2-year, twice-a-year thing, and I didn't do that. I kept it simple. So that's the forward curve, and it's a pretty easy formula. You just raise something to the 15th, divide it by something raised to the 5th. You take the 1/10 minus 1, and essentially what that's saying is, let me go buy this, and in 5 years, that'll be worth that. And then I'll take that at the end of 5 years and I'll put it in this bond for 10 years. At the end of 15 years, I have $1.43, or I could have done what? I could have just put it all in this for 15 years. And what would I have? The exact same thing. Right? That's what the forward curve is saying. What does the 10-year treasury need to be in 5 years so that you're indifferent between buying the 5-year today and then buying a 10-year in 5 years or buying the 15-year today? Is the forward curve important? I have to tell you the story because I remember this so well. I was sitting in my office, minding my own business. The phone rings. I don't recognize the number, so I answer it. It's the CEO of UTSA. So I'm clearing my voice. Yes, sir. He says, Ron, I'm in this room, all these finance people, and none of them know how to do the forward curve. Can you show them how to do it? And I'd taken the CFA exam. So yeah, I know how to do the forward curve. So yes, sir, I can do that. I would have lied if I didn't know how and Googled it real fast, but I did know. And so, you know, I'm on the speakerphone with 30 of my peers sitting in this room, and none of them know how to do the forward curve because they're all what? They're all accountants. But if you're an accounting major, you should learn how to do it as well, because you would have been the only person in the room with the CEO who knew how to do it. That would have been pretty impressive, right? So he says, why don't, because that's what he's saying. Why don't I just use the forward curve? And they're like, what are you talking about? Finance people know how to do the forward curve, 100% of them. If you graduate and don't know how, then you miss something in your education. So it's pretty common, pretty impressive to be able to do it. All right, so there's 2 approaches I give you on the risk-free rate. I can't really think of any others. And right now, I think using the current rate is fine. Just you need to address it somehow, at least talk about it. All right, especially with that big gorilla 2.4% 10-year treasury with inflation so high, you're going to have to make some comment about you expecting inflation to settle down, because That rate doesn't make any sense if inflation is going to stay above 5%. The next one is the market risk premium. So any questions on the risk-free rate? Now you think about your other classes, your professor gave you that number, but in reality, that no longer is going to happen. Once you graduate, you got to go get these numbers yourself. So this paper is telling you, go get your own number. I'm not giving it to you. All right, you've got to figure out how to get these assumptions yourself because that's what you're paid for in finance. So go figure out how to get these numbers. The second number is the market risk premium. The market risk premium, what we're going to do is exactly what you did on exam one when you started off the discussion about what a stock is and the expected return on stocks. Remember, expected return on stocks is a dividend yield plus expected earnings growth. Do you all remember that? Expected earnings growth is going to be closely tied to economic growth. You're going to put all that into your paper 3, and then again reference it in paper 4. So you need some inputs here. So my risk-free rate, I'm going to use 2.4%. And then my market risk premium. So what we're going to use the implied approach. Right? I'm going to force you to use the implied approach. There's 3 approaches. There's actually 8 or 9. If you really want to learn this, it's an extremely important number. The market risk premium is frequently referred to as the most important number in finance. And there's many ways to calculate it. If you really want to get into it, actually, JP Morgan produced a whole paper on this where they showed you, I think, 8 different approaches. And it came to my inbox at UTSA and I took it home. I was supposed to send it to the next person and sign off, but I just took it home with me. I didn't give it to the next person. So some poor guy at UTSA never got to read that. I thought it was great. So I emailed JP Morgan and asked if I could photocopy, because it said do not copy everywhere. I emailed them and they said, yeah, you can share it with your students. That's fine. It's a little dated, so the numbers are old, but the approaches are fine. So if you want to really see that, it's really well done. I converted it into a PDF, so just email me and I'll send it to you. So there are other approaches out there. The most famous approaches are the historical approach and the implied approach. So we're going to use the historical approach. We're going to use the implied approach. I used the historical approach most of my career, but we switched from the historical to the implied. But there are others. There are other approaches to coming up with this number. But just think about, what is this number? This is the number that says for the average stock investor, how much return do they need over the risk-free rate to induce them to buy stocks? If the risk-free rate is 2.5%, what do they want the stock market? Not your stock. The market risk premium has nothing to do with your stock. We're talking about stocks in general. How much more does the stock market in general have to pay over the risk-free rate to induce people to buy stocks? The historical approach says, well, historically, how much is it made over the risk-free rate? The implied approach says, what is the market pricing right now expected going forward? And we're going to use the implied approach. All right, I'll stop it there. This is exciting stuff, so we'll get into it next class.